Hi, I'm Siu Ling Hui with part 7 of a video series about how your financials can help you manage and drive business success. In this video, we'll look at what happens when you invest in equipment for use in your business and the related issue of how you finance this capital expenditure. First, a quick recap. We've been focusing on the financial effect of operating or trading activities of our hypothetical business in parts 1 to 6 of this series. We are now going to look at what happens with the other two common business activities, investment and financing. In this video, we'll be looking at the financing of capital expenditure. That's the purchase of investment in assets that will be used by the business. The way in which we finance these types of purchases will affect the profitability, cash flow, and financial position of the business over the long term. This video will apply concepts such as fixed assets, also known as property, plant, and equipment, capital expenditure, depreciation, accumulated depreciation, and their impact on your finances. I've explained these concepts in my video, What is Depreciation, and the effect on profits and cash flow. So if you aren't familiar with these concepts, please watch that training first and then come back to this video. Okay, let's start with buying a laptop for use in the business on the first day of month 8. The laptop costs $1,200. I'm going to ignore any consumption taxes like GST, VAT, or sales tax. The laptop has a useful life of 3 years and is expected to be worth nothing at the end of 3 years. We'll assume that it's depreciated on a straight line basis. So that's depreciation expense of $400 a year. That's its cost of $1,200 divided by 3 years. Let's assume that the business uses its own cash to pay for the laptop. We're going to keep to the trading assumptions we've been using so far in this series. Sales will grow to $20,000 this month. We'll keep the same mix of 80% credit sales and 20% cash sales. We'll hold inventory levels at $2,000. Wages will stay at $400 a month at this stage, and our supplier is still giving us 30-day credit terms, and we pay on time. Let's look at what month 8 financials show us about the business. First, the profit and loss. This month's expenses will show depreciation expense of $33. Actually, it's $33.33. That's $400 annual depreciation divided by 12 months. Your balance sheet will show the computer under non-current assets in a category which is either called fixed assets or property, plant, and equipment. You'll see the cost of the computer, that's the $1,200, followed by a negative number called accumulated depreciation. This is the cumulative depreciation expense associated with the computer. So far, we have only 1 month's depreciation expense. The accumulated depreciation reduces the value of the computer in your books. So the net book value of the computer at the end of month 8 is $1,167. Let's have a look at what happened with the cash flow in month 8. First, let's deal with the purchase of the computer. The purchase shows up as capital expenditure of $1,200 under investment activities in the cash flow statement. This is a cash outflow. The business used its own cash to pay for this, so nothing appears under financing activities. Now let's go back up to the cash flow from operations section. Depreciation is a non-cash expense. It's not like working capital items where we are making adjustments to reflect timing differences for receipt of income and payment of expenses. Depreciation expense will never be cash, so we have to eliminate it from the net profit figure to get to the net cash flow from operating activities. We do this by adding depreciation expense back to the net profit. You could think of that adjusted net profit figure as a rough proxy for cash profit before the timing impact of working capital items. So in month 8, your operating activities generated $4,002 in cash and you spent $1,200 on the computer. The overall net cash flow for the business in month 8 is $2,802. Now, let's see what happens when we buy a much bigger ticket item like a forklift and finance it with debt. Let's say the forklift cost $15,000. A forklift has 11 years useful life for tax purposes. We'll assume that by the end of 11 years, that forklift isn't going to be worth anything. So that forklift will be depreciated at $1,363.64 per year. Now, $15,000 is a lot of money to pay out of our own cash. Let's say we are doing this also in month 8. we only had $11,102 in the bank at the end of July, and we are also buying a $1,200 computer this month. So we decide we'll get a loan to finance the purchase of the forklift, and we'll do that with a form of equipment finance. Equipment finance is a broad category of financing solutions that are specifically tailored for financing equipment. The term equipment includes things like cars, trucks, plant and machinery, computers, and so on. Some examples of equipment finance facilities are commercial hire purchase, chattel mortgage, and various types of leasing. Equipment financing is a very effective way for businesses to finance both new and used equipment. There are important differences between the various types of equipment finance. For example, who is the legal owner of the equipment? The legal owner of the equipment is the party who is entitled to claim depreciation as a tax deduction. With a finance lease, the legal owner is the financier, not the business. Then there are other issues like, do you have the right or obligation to buy the equipment at the end of the contract? Can you cancel the contract? Do you have to finance the whole purchase price of the equipment? Or can you trade in your existing equipment as a deposit to reduce the amount borrowed? Then there are the different tax and accounting treatments of different equipment finance facilities to consider. All these issues have financial implications for your business. You should always get professional advice about the right type of equipment finance for your business. To keep things simple, let's say we finance our $15,000 forklift with a chattel mortgage. A chattel mortgage financing facility is simply a secured loan with a fixed interest rate. The business owns the forklift from the start, and the lender takes a mortgage over the forklift. Repayments are a fixed monthly amount, so that gives us certainty about our payment obligations. Our forklift has a useful life of 11 years, but equipment finance facilities are usually for between 1 to 5 years. Let's say our bank is happy for us to have a 5-year chattel mortgage facility. We could pay off the whole cost of the forklift over the 5 years. But let's say we want to conserve cash flow in the business and would rather have a payment program that more closely reflects the useful life of the equipment. Let's say under the tax guidelines, the residual value of the forklift at the end of 5 years is 40% of the original cost. That's $6,000 for our forklift. Let's say that this is also the estimated market value of a 5-year-old forklift under the bank's guidelines. Lenders tend to stick to the guidelines set out by the tax office. So the bank gives us a chattel mortgage facility of $15,000 with a balloon payment of $6,000. Balloon is a finance term for a large principal payment at the end of the term of a loan. Instead of paying off the entire $15,000 over 5 years, we pay smaller installments during the term of the loan and then make a final payment of $6,000 at the end of the 5 years. Doing it this way allows us to conserve cash flow during the 5 years. At the end of the loan term, we have a choice of paying the $6,000 from our own cash or getting a new loan to refinance the $6,000. Assuming an interest rate of 8.5%, our monthly repayment would be $225.55. But if we didn't have the balloon payment arrangement, our monthly repayment would be $305.58. I'm going to ignore any taxes like goods and services tax or value-added tax on this purchase. There are added complexities with these types of taxes in equipment finance. As I've said, you should get advice from your accountant or tax advisor before you enter into these types of transactions. Here's a table that shows you how much principal and interest you'll be paying over the 5 years. Your regular installment payments of $225.55 a month adds up to $2,706.61 a year. That pays off $9,000 of the total borrowings of $15,000 over the 5 years. The remaining $6,000 is paid off on the last day of the loan. That's the balloon. The total interest for the 5 years is $4,533.07. Now, here's a detailed payment schedule for the first 12 months. Your lender will provide you with this type of information for the full term of the loan, or your accountant can do it for you. The schedule shows you how each installment is split between interest and principal and the amount owing on the loan after each payment. I'll explain why the loan balance is more than $15,000 in a minute. You can see that with each installment, the principal component gets higher and the interest part gets lower. That's because with each payment that you make, you pay off some principal. So as the principal amount owing decreases, the amount of interest reduces as well. By year 5, each installment consists mostly of principal. In the final month of the loan, there's only $42.20 of interest and $6,183.35 of principal. That includes the $6,000 balloon payment. Now, let's see what happens in your accounts. Let's start with the profit and loss. We pay the first installment of $225.55 in August. This first installment consists of $120.90 of principal and $104.65 of interest. Only the interest amount is charged as an expense in the profit and loss. Interest is the cost of using other people's money in the business. Repayment of principal is not an expense. It's the reduction of debt. We also have depreciation expense for the forklift of $113.64, call it $114. So that together with the depreciation for the computer makes total depreciation of $147 in August. Now, let's look at the cash flow statement before we move to the balance sheet. On the day that you settle the purchase of the forklift, your bank will pay the $15,000 to the forklift seller, but your accounts will show the cash outflow of $15,000 as payment for the forklift and cash inflow of $15,000 from the bank loan. That's the drawdown on the chattel mortgage loan. Now, in our example, the loan repayment installments are made monthly in advance. So at the time of the settlement of the purchase, the bank will also take that first installment of $225.55 from our bank account. Part of that is interest and the other part is principal. This means that the net cash inflow from financing is only $14,774.45. The overall net cash flow impact of the forklift purchase is $225.55, which is the first loan installment. I've split the cash flow statement into two parts to make it easier to read. Interest expense was deducted to arrive at the net profit. We want to eliminate finance charges like interest expense and interest income when we assess our operating cash flow. So by doing this, we isolate how much money the operating activities of the business churns out or eats up. This helps us to properly assess the funding requirements of the core trading activities, the ability of the business to pay interest and repay borrowings, and so on. Now, to do this, we add back interest expense to the net profit figure, and we show the interest expense as a cash outflow under finance activities. We had $4,002 generated from operating activities. We spent a total of $16,200 on equipment for the business this month. But because we financed the forklift purchase with debt, the cash flow impact of this is only $1,426, $1,200 for the computer and $226 for the installment payment for the forklift. So our net cash flow is reduced by $1,426 to $2,576. But it's still positive cash flow. We have more money in the bank at the end of the month than at the start, even though we bought $16,200 worth of equipment. Now for the balance sheet. The business now has got over $16,000 in the long-term or non-current assets part of the balance sheet. The value of the equipment on the books will reduce with the monthly depreciation charges that are added into the accumulated depreciation lines. You've grown the assets of the business with borrowings instead of using the business's own cash. You've now got debt in the form of a chattel mortgage loan as part of the liabilities on your balance sheet. This changes the financial risk profile of the business. We'll go into ratios like leverage, interest cover, and so on in another video. This loan is split into two parts, current and non-current. Under accounting standards, the loan payments that are due within 12 months are classed as current liabilities. The payments that are due beyond 12 months are classified under non-current liabilities. This is important as it affects the liquidity position of the business. Note how there are three lines relating to the chattel mortgage. A gross amount which is reduced by something called unexpired interest to give you a net amount owing under the chattel mortgage loan. The gross amount owing for the chattel mortgage is $19,308, but you only borrowed $15,000. So what's this about? Under the accounting standards, the total of all the installment payments are put onto the balance sheet. So when the chattel mortgage loan starts, you will have $19,533 shown as the gross amount of debt under the chattel mortgage on your balance sheet. That's the total interest of $4,533, the $9,000 principal amount that will be paid off in installments, and the final $6,000 payment that you have to make at the end. But you may not end up paying all that interest. If you chose to pay the debt loan out early, say after 3 years, you'll have to pay all the remaining principal that's still owing, but you don't have to pay the remaining future interest amounts. You'll probably be required to pay a break fee or some sort of penalty, but it's not going to be equal to the future interest amounts due. So what happens in the accounts is that the future interest component is backed out. That's what the line called unexpired interest is about. It's only the net amount that counts towards the total liabilities on the balance sheet. This three-level way of showing a loan liability on a balance sheet is also used for other equipment finance facilities like hire purchase and finance leases. The terminology will be different, but the principle is the same. There's a gross amount of all the installments for the life of the contract, then the future interest component is backed out, and you get the net principal amount owing. On the very first day that loan is drawn down, you will also have to make the first installment payment. And part of that payment goes to interest and part goes to principal. So this is how you end up with the amount for current and non-current liabilities at the end of the first month, which is August in our example. Let's do a quick recap of what we've covered in this training. There are 3 broad categories of business activities: operating, investment, and financing. Capital expenditure is the purchase of assets like plant and equipment for long-term use in the business. It's not something you do every day, and there's usually a big cash outlay involved. So to manage your cash flow, you need to assess the appropriate way of financing this type of expenditure. You don't want to drain your cash reserves by paying with cash. This could create problems, especially if you need to be funding working capital growth as well. But taking on debt also changes the financial risk profile of the business. We'll discuss this issue further in another video. In this video, we focused on equipment finance, which is a very efficient way of financing investment in plant and equipment, vehicles, and so on. There are many types of equipment financing facilities, and each type has its own accounting and tax implications. You should always get professional advice as to what is the most appropriate way to finance equipment for your business. We use a chattel mortgage loan as an example. This is essentially a secured fixed interest loan. The terms and conditions of a loan has implications for your future cash flows. Do you push out the repayment with a balloon structure, or do you pay down the loan as fast as possible? All these decisions will affect your business profit and loss, cash flow, and balance sheet. I would really appreciate your feedback on this training. Please put any questions or comments below and I will respond. If you have a specific issue or question about your business finances, you can contact me directly through my contact page at incontextfinance.com. Master your cash flow, know your finances so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.